All right, we are live. Hey guys, hope you guys are doing well. Happy Wednesday. And hey, we're here to coach you guys up here and really dive into. If you haven't heard the news lately, interest rates are on the rise. I mean, it's everywhere. If you haven't heard the news, then maybe it's time to get out of the rock. Rock. But yeah, interest rates are on the rise. Hey, stock market's on a decline. Have you heard that too?
Oh, I've heard that.
Yeah, that's a big one. Every day it's in the news right now. Stock market. Hey, listen, Jen, when it comes to the stock market, you know what's happened? We've had it was either April or May, I can't remember which month it was, the biggest decline since 2008. Remember 2008?
That's a hard one to forget.
Yeah, it's a long time ago. I remember that too, but one of the biggest drops in a month since 2008. We've had definitely the biggest drop this century as well. It's in the last 22 years, the biggest drop in the market. So what does that mean for everybody? Right? What does this mean for you guys and where you guys are at here? Here's another one, Jen. Are we headed for a recession? Have you heard that word yet?
Oh, that word is flying around.
Yeah. Once that, it's kind of funny. I'm like, do we go into recessions because like the technicalities of the market and we just hit one, or do we go into recessions because people start calling things recessions, and then as a society we just act like we're in a recession? We stop spending, we save a little bit more money, right? Like I always wonder, is there's a whole egg or chicken approach there. What comes first, the egg or the chicken? And I always wonder that with a recession, what comes first? Do we talk about it and we hit one? Because technically we're kind of right on the edge of one, but we're talking like we're in one. Right. The stock market last week just officially hit a bear market last week. So anyways, just some interesting to talk about. So are we headed for a recession? Will life continue to get more expensive? Have you noticed things got a little bit more expensive in the last couple of months?
Try filling your gas tank.
Oh my goodness. I was talking to a girl yesterday. Oh, really nice truck. She came to pick up a couch from her house. Really nice Harley Davidson Ford F-150. I was like drooling. All nice leather, and it was awesome. It's like, damn, this truck looks amazing. How much is it to fill? So she's like, well, when gas prices were like $1.10 a year ago, that's a liter, so like $4.40 a gallon. It was like $100 bucks, $150. I'm like, how much is it now? She's like, I don't know. I don't let it get down low enough to figure it out. She's like, I just put $100 in it to fill a quarter tank. So,
wow.
Whew. So our life, is life could continue to get expensive like this? Are we, when we look at inflation in the past, when we look at trends in the past, are we going to continue to move in this direction? And then here's another one. Can we trust the stock market? Can you trust this? I hear this all the time. I talk to people all the time. Jen, maybe you do too. People who do not invest because they don't trust the stock market.
Yeah.
And so we're going to dive into all of that today, guys. Give you guys clear direction on what to do, how to handle this, what we think is going to happen over the next let's talk long term. We can always talk short term. Problem with short term is if you read anything short term, it's fear. News on the daily, short term news is always fear driven. But when you look long term, where are we going here? What do things look like? Could you predictably be okay? Are you going to financially be okay? Where do we go from here? So let's start with this one, Jen. You ready to dive in?
Yeah, let's do it.
So I saw this circling about a week ago, and I saw people posting this on over Facebook, and then I saw it in the news. I thought, oh man, like this is clickbait to the core. Because when you first read it, it grips you and you're like, oh. But then when you read the details, it's like, oh, not that bad. All right. So here it is. Headline news. Bank of Canada, this is in the US too. This is US news as well, but I pulled this article from a Canadian article. Basically says Bank of Canada, some Canadians could see mortgage payments jump by 45% in 2025 to 2026 as rates rise. So we're talking 3 to 4 years, because it's 2022 right now. 3 to 4 years, people could see their payments rise by 45%. Right?
Who wouldn't freak out reading that?
Yeah, I mean, even I saw that. I was like, whoa, hold on here. So I opened up the article, And it says, this is what it says. So some Canadians who took out mortgages in 2020/2021 could see their monthly payments jump by as much as 45% in 2025/2026, given rising rates, according to the Bank of Canada, which is what they released about. This is back in June 9th, so a couple of weeks ago. Elevated levels of inflation, which is currently at a 31-year high.
I believe
So
it.
we haven't seen inflation this high since the 80s, if I do this right. Yeah, since the 80s. So 31-year high. No, hold on. This would have been maybe the 90s, late 80s, early 90s.
Like 91.
Yeah, 91. Yeah. So 31-year high could also mean that households allocate more of their income to food, gas, if wage increases do not keep pace, which, let's be honest, we know wages ain't going up 9% this year, right? Inflation's gone up 9% and wages ain't going up 9%. So, okay, so we know that. The central bank said in its annual financial system review, it's annual there. In this context, highly indebted households are especially vulnerable to loss of income. The bank increased rates by 50 basis points in April, did it again in June. So, we saw all that happen. And money markets are battling another half point raise in July. I don't know if it's going to be a half point in July. It might be 75 basis points. I mean, that's in the US, that just happened a couple of weeks ago. Last week, 75 basis points is what it went up by. Canada tends to kind of follow. So maybe we're looking at a little bit more rise come July, but we'll find out in a couple of weeks. Canadians and Americans with high loan to income ratio, variable rate mortgages would see payments rise by 45% in 2025/2026 upon renewal. The overall increase in monthly payments for all types of mortgages ongoing in 2020/2021 would be about 30%. This scenario focused on mortgages with a 5-year term taken out at banks in 2020/2021. So number one, at the lowest point, probably in history for mortgages. 2020/2021, you could get mortgages for 1%. 1%. Where else in history have you had a mortgage for 1%?
Yeah, I don't know.
Never.
Probably never.
That's never happened. You've never been able to borrow at 1%. So let's put this into perspective, guys. In 2020/2021, you could borrow money at 1%, which made the cost of borrowing super cheap, which made the market very competitive because almost anyone can qualify at 1%. Which drove houses up to what we are today. By 2025/2026, so 4 to 5 years from now, 3 to 4 or 5 years from now, so a lot of renewals are going to happen then. They're estimating interest rates are going to be at 4.5%. At 4.5%, you are still lower than the average. The average being 5%.
Yeah.
That's been the average over long term in the mortgage world. 5% is what was what we've kind of always kind of averaged out well before 2008 when interest rates all of a sudden dropped. We were averaging 5%. So even in 3 to 4 years from now, you're still below average. But yet this clickbait article probably made you think, oh my gosh, fear, overwhelm, anxiety. What am I going to do? And we're not even back to normal.
Yeah.
Which is pretty crazy. Jen, when you started here, when you got your first house, your first mortgage, what were you guys paying?
It was between 5.6 and 5.9. I can't remember which one, although I lean toward 5.9.
Okay, so almost 6%. So after high inflation, after the banks raising interest rates to kind of combat inflation, we're still not paying what you would have paid when you first got your house.
Yeah, and that would have been 2006.
2006, yeah. 2008 is when it kind of really started to drop. That was to pull us out of a recession, and then rates just stayed low.
Yeah.
The last 14 years, I guess. Yeah, 14 years. 14 years, which is why your house is worth so much today. For anyone that's wondering why housing prices, I mean, there's a couple reasons for that. One being interest rates being low, so the cost of entry was super low. Almost anyone can qualify. Number two being we don't have enough houses on the market for the people that want to buy. So that's another reason into this. As rates go up, though, there'll be less people in the market. So I don't know if your houses will go down in value, but you definitely won't be getting $100,000 over asking anymore.
No, and we're already starting to see that change, right?
Yeah. We're slowly seeing that where houses are going for asking, a little bit below asking now is what we're seeing in some areas.
Yeah.
So we'll see what happens here. Basically, from the way I understand it, I heard this the other day. Can't remember if it was every 25 points or if it was for every 1% things go up. But anyways, it takes out about 100,000. No, it takes out about 1 million buyers.
Oh,
I
interesting.
think it was for every 0.25% rates go up. It takes out about 1 million buyers from being able to qualify in the market.
Yeah.
So if you think in the last 6 months, we've gone up a whole percentage. So about 4 million buyers have been taken out of the market.
Yeah.
And as we continue to go up, more and more people will be taken on the market, which brings you back into the law of supply and demand. If there's less demand and more supply, then you're not going to see houses go up as high.
Yeah.
Right. That's just the idea. So since 2008, we haven't kept up. Before 2008, the problem was we had more supply to demand. Houses, we remember prices in 2008, right?
Oh yeah.
I bought my first house in 2010. We paid $285 for a nice big home. That house today is worth $1 million. Is it really worth $1 million? That's what people are willing to pay for it. Would I pay that for it? I don't know. It's a brick home. It's a 2-story brick home. Nothing special.
Yeah.
We were in a fishbowl. We had a backyard, but backed onto someone else's backyard. 2 houses. Like, it wasn't like anything crazy.
Yeah.
Today, that right now, that's about $1 million. We'll see if that stays there. But what happens is if a supply starts to fall off, interest rates go up, so people don't qualify. Supply starts to fall off. We should see the housing market cool a bit. That's the idea.
Yeah.
For all those people that got interest rates at 1%, they got your mortgages at 1%. Good job. I doubt you'll ever see that again. Maybe you will. Who knows? I can't predict the future, but that is not normal. So when you renew in 3 to 4 to 5 years and you're paying 4% or 4.5%, like this article talks about, that's normal. You are in the ballpark of what normal has been for the last 30, 40 years. The average, right? So you got the ups and the lows, and you can kind of average them out about 5%. That's where we're at. There's a whole generation out there, Jen, that has never seen interest rates above 3%. That's me. That's my generation. I bought my first house in 2010, bought my second house in 2011. And not once have I paid more than 3%. Even today, right now, I'm still under 3% with the rise in, and I'm in a variable. So my interest rates are going up. And even right now, I am still under 3%.
Yeah.
14 years, my whole adult life, I've never seen a high interest mortgage.
It's pretty crazy, right? Because our parents grew up in a very different time, like
18%.
My parents had a home, 18%.
Yeah.
Yeah.
And so here's what's funny about that. So that was that the 70s for your parents? Would that have been around the 70s?
It would have been the early 80s.
Early 80s, late 70s, early 80s.
Yeah, 80, 81 maybe.
So we're studying right now. I'm studying right now recessions.
Mm-hmm.
I just started to dive into the dirty 30s, kind of what caused it, the environment at the time, the psychology of the day. So I learned a bit about that. Right now, I'm also learning about the 70s, the big recession we had in the 70s when interest rates went up. And as much as we hate, much as people probably hated 18%, the reason why it went up that high is the same problem we have today. They were combating inflation. Inflation, as high as it's been at that time, late 70s, early 80s, it's as high as it's ever been. And so they had to combat it. And what they did back then, and they might have ripped the Band-Aid off really fast and really hard. We're doing it a little slow. 0.5%, 0.25%. Like we're doing a little bit slow because they're trying not to put us into a recession, which is a good thing. We don't want to go into a recession, but sometimes we go into a small one. Anyways, they just ripped the Band-Aid off increase interest rates to combat inflation. They got it down, but it hurt for a while, especially those who locked in at 18%.
Yeah.
It hurt for a long time. And so we're seeing the same kind of things today. So here's what happens, guys. And this happened in the 30s, Black Tuesday, 1929, where the stock market just dove. Happened in the 70s. And I'm sure it's happened in some other points as well. Well, essentially, the story is the same. The government has flooded the market with cash. The more cash you have in the market, the more it takes away your purchasing power. When you take away your purchasing power, that's called inflation.
Yeah.
To combat inflation, you got to raise rates and slow the economy down, or else what's worse than higher interest rates is higher inflation. That will kill an economy more than slowly raising interest rates. So this is a good thing to be going through right now because of that. How long we go through it for, I don't know. I assume as soon as inflation gets back down, they'll probably steady it off for a little bit and start to lower it down. Maybe not. I can't predict the future, but that's what I think would happen. So if this takes 2 years to kind of get inflation back down to normal rates for Canada, I think it's about 2.6 to 3%. For the US market, I think it's roughly around 4%, maybe a little bit less. As soon as we get back to normal, we'll probably see the rates kind of steady for a while and then slowly start to come back down. So that could be 2 years, 3 years down the road.
Yeah.
But that's why I'm not worried, guys. I mean, listen, clickbait. That's what these guys are trying to do here. If you aren't reading these articles, advertisers aren't paying them. That's what's happening. So here's the takeaway, guys. Here's what I want you to understand with all this. Number one, don't make decisions based off of fear. Fear does not get a great outcome for you. Okay, so don't make your decisions based off fear. Don't plan today, for when you got to renew in 4 or 5 years. Don't worry about that right now. Wait till it comes. We're going to be in a different spot in 4 years from today. 100% guaranteed you'll be in a different spot from today. So don't make your decisions today based off fear of what might happen or what might not happen tomorrow. This whole article is speculative. We think we're going to have to do this. We might have to do this. You hear those words while I was reading it?
Mm-hmm.
It's possible that this might happen. So it's speculative. So don't make decisions based off of fear, because making decisions out of fear will never cause you to make a great decision.
No.
You just can't. You can't think logical in fear. You can't make great decisions when you're living in fear. And we've seen many examples of that. Number two, remember, a lot of what you're going to read over the next couple of months, and maybe over the next year, this may last a couple of years. The dot-com bubble lasted 3 years. The top was 2000. For 3 years, we dropped. And then we came back up. 2007, we hit a top again. For about 18 months, we dropped. And then since 2008, we've just been going up. A couple small dips here and there, but the last 14 years, we've had the longest growth in the market ever in history. And so understand a lot of this is going to be clickbait. You're going to be clickbaited into reading things, because the more you click and read, the more advertisers are going to pay. So just understand that these titles are there to catch you and grab you. It's classic marketing. And a good marketer knows how to get you to pay attention, or else they wouldn't be in the business. So understand a lot of this is clickbait. All right. And the truth is, guys, you got to look at the facts. The average mortgage rate over history has been 5%. So even in 4 or 5 years now, we're still below the average. Okay. The facts are that if you guys will work a plan to get out of debt here, if you'll work a plan to live debt free, it doesn't matter what happens in the market, you're going to be okay.
Yeah.
All right. And the number 3 here is one of the best returns, guys. I want you to write this down. One of the best returns you can have right now, regardless of how high gas prices go, how high food prices go. One of the best returns you can have here is to get on a plan to completely become debt free. And if you'll do it the right way, there's a good chance the majority of you can become debt free in the next 24, maybe 36 months. That's 2 to 3 years completely consumer debt free, which means if this does last 3 years, like back in 2000, this lasted 3 years, right at the bottom, you're debt free and you're taking advantage of the very bottom and going up from there. So now is the best time to get debt free and walk in this process. hands down, that's where we want to go here. So hopefully that makes sense, guys. When you see this clickbait, when you see these articles, look deeper into them. Don't just read the headlines. I see a lot of people texting or posting the headline news with their comments, and then when you go to read it, you're like, it's not that bad, really. But listen, we love fear. We love scarcity. A lot of us are attached to that. That's why we're glued to the news a lot of times.
Yeah.
You know what I'm saying?
Yeah, absolutely. Right. Like, cause it kind of hits us down in our core, because we're designed for survival, in one way. And it kind of hits to that survival of, we're in danger. But when you can read between the lines and you can look at it with perspective outside of fear, you realize, okay, it's not that bad. I just need to be prepared and I need to plan differently. Right.
Yeah, absolutely. So with that being said, let's talk about the stock market.
Yeah.
Let's talk about the stock market. What's going on here? I mean, listen, we've seen big drops here. Well, what are you seeing, Jen?
Yeah. Found this article about the stock market sell-off could just be getting started, which for lots of people, you just have this image of little cartoons running around on fire, right?
Yeah.
It's on fire.
It's on fire. The sky's falling.
Right? The little chicken. Chicken little.
Yeah. Stock market sell-off could just be getting started. Okay. Well, let's dive in. What is this article saying?
Yeah. So this article here is really diving into the fear. Like, first line, if you're nervous about the stock market, you've got good reason to be.
If you're nervous about the stock market, you better be nervous about the stock market.
Right? You'll be crying by the time you finish this article.
You'll be in tears and you'll be on the floor. Yeah.
Right? So it talks about, central banks around the globe are losing the battle against inflation. Their response to plunge the global economy into a recession.
So let's just stop there. Losing the battle against inflation. We just started. The battle just started. Like, guys, interest rates just started going up 3-4 months ago. The battle just started. Inflation just started skyrocketing about 6 months ago.
Yeah.
Anyways, right there's misinformation right there. But anyways, let's continue.
Yeah. It's the way it's spun, right? Like, we really have to hear the words, right? And they sound really bad. So it continues on and it says, last week, Federal Reserve hiked interest rates by 0.75 percentage points.
So that was the 75 basis points. That's what we were just talking about.
So 0.75, right? Mm-hmm. The biggest rise since 94. Mm-hmm. Bank of England increased its target rate too for the 5th time since December. Swiss Bank raised the rates for the first time in 15 years. So again, it's kind of tied to that article you were sharing, Mike, where, we've had this long period of time of low interest rates. It's kind of like going to high school and getting no homework. It's unrealistic. Right? But
hey, I love that. I loved high school with no homework.
That's the world the kids live in right now.
That was my favorite time. And where everybody won, right? Yeah. Yeah. No, everyone loses when we have that mentality.
Right? Exactly.
Yeah. All right.
So it continues on to say that inflation could spike near 11% in the fall. And the speculative again. Yes.
Yeah. Yes. Could happen.
Could. And just increase its inflation expectations for 2022 by a full percentage point.
Yeah. So it's funny because we're kind of, I think, depending on where you look at the data, we're 8%, 8.5%. So, technically we could go up another, 3%, 2.5% inflation by the fall. It's possible. Not discounted that it can't happen. There's ways around it. Like I said earlier, we're slowly taking the Band-Aid off this time. We're not ripping it off anymore. But what does it say about the stock market? Are we going down now for the rest of our lives? Is this it? Are we done? Is this a 2008 where get out because we're done? The economy's over as we know it. Remember that?
Yep, absolutely. Well, the article continues and it says, lots of things going on in the world right now are impacting it, pulling back stimulus, putting monetary policy engines into full reverse. Central banks have rattled investors. U.S. stock market has entered a bear market, and Wall Street Wall
When
Street.
officially last week we entered one.
Yep. And then Wall Street saw the worst since March 2022. S&P 500 went down 6%, and the Dow plummeted by 1,500 points, or 5%.
So what does this all mean? Do I have to sell my investments and go hide under a rock? Because oh my gosh, the world's just unstable.
Yeah.
Or
no,
is it?
Don't do that.
Or is it? You know what? Here's some truth behind this, guys. Is I can't remember the exact year, if it was 1827 or 1857. I don't remember exactly when, but it was around the 1800s. If you track all the recessions we've had since the 1800s, we've had about 34. About 34, which averages a recession every 4.8 years. Now, what you got to understand in a recession, all a recession is essentially the economy is shrinking, which means it's not producing for 2 consecutive quarters, so 6 months, the economy's not producing as much as it was. It's falling a little bit behind. Yeah. You cannot get 12, when we talk about 12% rate of returns and 15% rate of returns, which we talk about all the time in the market, you do not get those types of returns unless you have a pullback somewhere in the market. You have to have a pullback somewhere to continue to get those types of returns long term. Right? That's just the way we do it here. And yeah, they're right. We've officially hit a bear market. When I study recessions, again, every recession is a little different, right? So I can't say this is what happened in this recession is going to happen this time. Everyone's a little bit different. The reason's a little bit different. But on average, if you average them out, in a recession, the market drops by about 35%. We're not there yet. We're about 25%, maybe a bit more now. Last week we were at 25, so maybe we're a little bit more now. But about 34% seems to be roughly where the bottom is. And then it kind of starts to recover and go on from there.
Yeah.
So the way I look at it, Jen, I don't know if you're about to talk about this, but I'll let you talk about this. It's time to buy.
It's on sale.
Are you going to talk about that, or?
Yeah.
Yeah. Okay. I'll let you start talking then, because it's on sale. It's time to get in, guys.
Yeah. Yeah.
When everyone here's what I've come to realize: when everyone's saying get in, just hold. Buy a little bit, and hold. When everyone's trying to get out, that's when the value of cash to use to get in is powerful.
Yeah, absolutely.
Take it over, Jen.
Yeah.
Take it over.
No, that was a great lead up to, it's a great time when the market is low. Legit, it's kind of frightening to look at your account statements, right? Like it can be, not all the time, but it can be, or at least some of your funds, you're like, oh, that hurt, right?
Yeah. That.
But like you said, when it is low, things are on sale. And when you're consistently putting money into the market, it's called dollar cost averaging, right? Yeah. So you're getting some things on sale lower, like right now when things are low, they're on sale. You know, a couple months down the road, maybe they're a little bit higher. And so your average price per unit ends up, meeting somewhere in the middle, but you can get more bang for your buck when it's low. Yeah. But you keep going, and it will keep growing. Because like you said several times, Mike, like we will hit these dips and it goes down, but it always comes back up, and it always comes up higher than it dipped.
Yeah. Right? Yeah. The idea is we fall faster than we grow. So the dips happen a lot, like they happen faster, but we always grow higher than we fall.
Yeah. So it's good to be in and to have that plan, which ties into what you were saying just a minute ago, Mike, about freeing up those dollars. When we have dollars going to debt and we're paying interest, we're not getting the reward that is offered to us in the market where we can be earning that interest.
Yeah, absolutely. Absolutely. And so you guys see this chart here. This is where we are right now. Here's our big drop. Our high was roughly about December was when we hit the high. And then since then we've kind of been dropping. But this is over here.
2008.
2008. Well, it looks like what is that? That doesn't even look like, that looks like nothing.
Yeah.
But 2008, when we were in 2008, we didn't know what this was, what looked like, what this was.
Yeah.
the last 14 years would be, and we couldn't see the future. 2008 looked just like this.
Yeah.
Boom. You can't see the future. But if you study the stock market and you understand how the stock market moves, we know that over the next 5, 10, 15 years, we're going up in the right direction.
Yeah.
Top right is the direction we want to go, and we'll go there. But when you scan out, right, it's hard to see perspective when you're so focused in. But when you scan out and you can see the stock market, you can see what it's done. There's that 2000 high I was talking about, that dot-com bubble right there. Yep. That's the high then. Dropped down. We hit the bottom around 2003, 2002, 2003, came back up, 2007, hit another bottom. And then since then, we've just been on fire.
Yeah.
And so here's the good news, guys. If in the last 3 years, the stock market is still up over 30%. If you were investing back in 2019, 2018, you're still your stuff, depending on how you invested, if some investments, right? But if you invested, mutual funds, ETFs, that type of stuff, if you just follow the market in your funds, you should be up about 30% right now. Despite the 25% drop we've had in the last 6 months, you should still be up 30%.
Yeah.
So what's all the hype about?
I'm not sure what the scare tactic is all about. It doesn't serve anybody.
It does serve somebody.
Well,
the advertisers.
Okay, fair enough.
We're making great money on this stuff right now because people are getting their eyeballs clicked. But that's the idea. You saw perspective. You saw 2008, which is 14 years ago, if I'm doing my math right. Yeah, 14 years ago. Mm-hmm. And you see where we are today. We would have to drop like 200, 300, 400% to get back to 2008 rates, which we're not going to do. It's not going to happen. The economy is too good to do that. Yeah, we'll drop, maybe another 10 points, maybe another 15 points. Who knows? Yeah. But then we'll recover and we'll start to get back up. So if you'll take advantage of what Jim was talking about, cost dollar averaging. So maybe you bought at the height and now we've dropped 25%. And you're thinking, oh no, should I buy? Is it go down? Is it going to go down more? I don't know. Who cares? Buy. And that high you paid, let's just say you paid $100 at the height, and let's just say today you can buy it for 50. Cost dollar averaging, we're now bringing that to $75.
Yeah.
And your stock doesn't have to go back up to 100 or to start to be profitable. It goes to 75, and you're profitable from there. I bought Starbucks at the height, $114. Yeah, it was fun. Today's worth 73, maybe. I don't know. I haven't checked today. I don't check it every day, but right now Starbucks is worth, I'll check right now, $73.55. I bought it at $114. I'm not waiting for it to get to 114 again to break even. So I've been buying it as it's been coming down, buying it as it's coming down. Right now, as I speak, it's got to hit $83 for me to break even. Bought it at 114, but continued to buy it as it went down. Now my break even currently, if I continue to buy, it'll be even lower, but currently is $83. So it's got to move $10 before I hit my break even. And then from there, I'm profit. And that's cost dollar averaging.
Yeah.
Every month, put a little bit away. If you're debt free, got an emergency fund, every month, put a little bit away. Continue to buy it as it goes down. Continue to buy as it goes down. I bought Zoom at $200. Zoom had dropped 50% at that point. It's like, hey, this is a good buy. $200, I bought it. Zoom went down to $83. From there, I was like, damn. Whew, I guess I was at the bottom. And it's like, okay, because Zoom's a good company. I like Zoom. Like, I buy companies that I really understand and I use and I know. And so I'm like, Zoom's a great company. Huge cash flow on their balance sheet. They got a lot of cash. They've been profitable every single quarter since they've hit the market. I'm like, these guys are a good company, good vision for the future. So I bought them. Not $83, a little bit higher, about $90 or so. I bought a whole bunch of $90.
Yeah.
And I'll continue to buy them. Now they're worth, today they're about $116 is what they're at. That was yesterday. I'm not sure where they are today, but yesterday when I checked, $116. So that's cost dollar averaging. And it's important that you continue to do that. But again, do not make decisions out of fear. Do not invest out of fear. Invest out of what you know to be true. That long term, the stock market is resilient. Stocks always go higher than they fall, but they always fall faster than they rise.
Yeah. Yeah. So there's not a lot to be scared of. right? When you're using wisdom and you're making decisions out of knowledge and wisdom and not fear.
Yeah.
And writing it out, right? Taking your time, being prepared, right? It's important to have that fully funded emergency fund before you get to this step, and do things in that right order. Be debt free, and then just start plugging in and ride that train.
Yeah, absolutely, guys. And you've got this. Trust us, and trust us. If you take this advice today, 5 years, 10 years, 20 years from today, you will be so glad you did it. And the moment you might be in scarcity and fear, that's okay. But take the right step here, and you guys will go and get that. Any last words of wisdom on this, Jen, on this investment side of things, and where people should be going?
Oh, I just want to encourage all of you to get on a plan. Start making it work, right? Yeah. Work the plan. Have that long-term mindset as well.
Yeah, absolutely.
Yeah.
All right, good. So let's do this, guys. Let's coach you up. We got one last thing here. We had a question come in, and Jen, I'm curious, you ready for this?
Yep.
So I had a question come in the other day, and this is what they asked: how are your clients making more money to pay off debt?
Ooh, great question.
Like, that's a really good question. And I said, I reply, the idea is this: when I look at most of our clients, most of them aren't making more money. So that was the first thing. I was like, great question. But we're not going to have the answer I think you're looking for, because most of our clients, some go make more money. They'll sell some stuff. They'll work a part-time job, the typical stuff.
Yep.
We'll teach them how to get a raise. Sometimes they can ask for a raise too and get a raise. We'll do all that. But most of them aren't going out to make more money. What are they doing, Jen?
A lot of them are just following their cash flow plan.
Why? No, that can't be that simple.
Mike, legit. Managed money behaves.
Managed money works harder.
It does.
So here's what they're doing. For those that are wondering, because that's not the first time I've heard that question. A lot of people ask, well, so-and-so paid off $20,000. They didn't explain how they did it. Yeah, they did. They got on a cash flow plan. They started to manage their money. Mm-hmm. The average person right now that does a cash flow plan the way we teach it finds an extra $250 to $500 more per month. Right there. They didn't have to work any harder. They didn't have to go drive Uber or deliver pizzas, which is okay if that's what you want to do. They just start to manage their money.
Yeah.
And what happens is they say, oh, Mike, yeah, we don't spend that much on eating out. So, when they first do the cash flow plan, like, yeah, we want to do just $50 for the month. And then what happens is the end of the month happens and we get them to track. And by the end of the month, they say, holy cow, we spent $500. I think I know where the hole in the boat is.
Yeah.
And then from there, it's like, okay, do you want to spend $500? If you do, you got to rise what you put in the monthly budget. Or are you going to kind of say, holy cow, okay, we need to fix this. And it slowly comes down.
Yeah.
And maybe you say, okay, we'll rise it to 100 for the next couple of months just to kind of ease it. But right there, they find that $400 difference.
Yeah.
They thought they weren't making enough. No, they just weren't managing what they made.
Yeah.
And then the next thing is they get focused on an outcome they desire to have. And when you get focused on an outcome that you desire to have, and you get defiantly committed to getting that outcome, you will start to do things differently. So for some, they learn how to negotiate interest rates on their debt. Sure, that can work. Others, they just say, no, we're done with this and we're going to pay this off. And they start to put money towards that debt and lob it on here. They don't spread it out amongst 10 debts. They get focused on one, they knock it off. Then focus on the other and they knock it off. And that's how they're doing this. And that's why the average person we're working with right now is knocking off about $15,000 in 3 to 6 months. For some of them, it's the first time ever. Mm-hmm. Were you on that call, Jen? Was it you or was it Neil that was on the call when, I won't say their name because they're in the community, but a client celebrated, I think it was $10,000 or $12,000 they paid off. And for the first time in 30 years, they had no credit cards or they had no credit card debt. Were you on that call?
I wasn't, but I do know who you're speaking of.
It must have been Neil on the call then.
Huge.
Yeah, for the first time in 30 years, I don't have a credit card payment. First time in 30 years. And we've only been with him for 8 weeks, I think, 2 months, maybe 3 months now.
Yeah.
And first time in 30 years, no credit card debt, $10,000 paid off.
Yeah.
Hello.
It's incredible. It's incredible what a bigger why will motivate you and push you to do.
Yeah. Yeah. So number one, get focused on a cash flow plan. I'd say number two, get focused on why. Getting out of debt is not your why. I'm just going to say that if getting out of debt is your why, you will probably be in debt for the rest of your life. Because when things get hard, if you don't have a strong enough why, you'll fall back in the old patterns. Maybe that's been some of the problems for a lot of people, is their why hasn't been big enough.
Yeah.
So we've kind of when life's hit the metal here, and it's like, do I really want to sacrifice to make this happen, or do I kind of just want to have fun now? And if the why is not big enough, you will fall back over time. It's like the people that want to lose weight, if their why is not big enough, they will sneak in a cheeseburger over time. So that's how they're doing it. Cash flow plan, a strong why as to why they want to get debt free, what that's going to cause them in their life to do. And then managed money always works harder. So when they start working the debt, paying it off, they're using the extra money to pay off the debt. And then that whole snowball effect happens. They pay off one, use the interest from that to the next, and all of a sudden it's only 24 months later or 36 months later, and they're completely debt free.
Yeah.
That's how they're doing it, guys. And so, hey, if anyone's interested in learning how maybe you can fast track your way to becoming debt free, fast track your way to becoming wealthy, the way we teach it here, or even fast track your way to just starting to win with life and feel good, hop on that 15-minute call. There's nothing to sell. I'm not going to pitch you to work with us or any of that stuff, but we're just going to dive in and say, hey, what's working? What's not working? Why are you stuck? And if we've got some resources that can help you, we'll get you connected there. If we feel that we can really help you with what we do in our coaching world, and we can really help accelerate your progress, we'll walk you through what that looks like and how that works. All right. So head over to moneycoachmike.com/call. All right. For that. And we'll hop on there with myself or with Coach Neil. Take a look at what's working. But here's what I know to be true. This will be the best 15 minutes you've spent on your finances in a long time, because on this call is we're going to get to the truth of where things are at and why they're there. And then from there, you're going to take action and make progress. All right, guys, we love you guys. We wish you all the best. Until next time, don't follow the fear that the news is going to put into your heart. Know that when we look at this long term, we're going to be okay. We're going to win. You're here to win with money, win with life. All right. And win in your world. We love you guys. We'll talk to you soon.